most people are going to lose money in the next market crash. And the crazy part, they won't even know why they'll panic. They'll sell. And they'll walk away with less than they started with. But a small group of people, the ones who understand what I'm about to show you, are going to walk out the other side with more wealth than they had before the crash even started. Today, I'm going to show you exactly how to set up your compounding so that a market crash doesn't destroy you. It actually makes you richer. Let's talk about something that most financial content completely ignores. Everyone talks about investing for the long term and staying the course. But nobody actually breaks down what you should be doing right now, today. So that when the market drops 30, 40, maybe even 50%, you're not the one panic selling at the worst possible moment. You're the one buying. I've been studying market history for a long time. I'm not here to scare you, but I also think you deserve the truth, not some watered-down version of it, because the truth is market crashes are not rare events. They are a completely normal part of investing. And if you don't know how to handle them, you are going to lose money that you didn't have to lose. So here is what we're going to cover today. First, I'll show you exactly how compounding works in a crash, because it works differently than most people think. Then, I'll walk you through 3 very specific things you can do right now to set yourself up. And finally, I'll show you the data, real numbers, that prove why the people who prepare for crashes always come out ahead of the ones who don't. This is important stuff. Leave a like, and let's get into it. The problem nobody talks about. Compounding is fragile. Here is something that took me a while to really understand. Compounding, the process where your money earns returns, and then those returns earn returns, is one of the most powerful forces in personal finance. Albert Einstein allegedly called it the 8th wonder of the world. But there is a side to compounding that nobody talks about. It is fragile. Not in the sense that it doesn't work. It absolutely works. The problem is that most people don't understand how compounding interacts with market crashes. And because of that, they do exactly the wrong thing at exactly the wrong time. Here is a simple example. Using real math. Say you invest $10,000. In year 1, you own 10%. So you now have $11,000. In year 2, another 10%. Now you are at $12,100. This is compounding doing its thing. Now imagine in year 3. The market drops 40%. You are not at $13,310 anymore. You are at $7,260. You've lost everything you made in years 1 and 2. Plus a chunk of your original investment. But here is where it gets really important. To get back to $12,100 from $7,260, you don't need a 40% gain. You need a 67% gain, because losses always hurt more than gains help. This is called the asymmetry of losses, and it is the most important mathematical concept in personal finance that almost nobody talks about. This is why people who panic sell during a crash often never fully recover. They sell at the bottom, lock in the loss, and then miss the recovery. According to a study by Fidelity, if you had invested $10,000 in an S&P 500 index fund from January to the end of 2022, you would have grown that to just over $1.082 million. But if you missed just the 5 best trading days over those 42 years, 5 days out of more than 10,000, you walk away with only $671,051. And if you missed the best 50 days, $76,104. You took on all the same risk. You sat through the same crashes, but you made 14 times less money just by being out of the market at the wrong moment. So compounding is powerful. But if you interrupt it, especially at the wrong time, you don't just slow it down. You can set it back by years. The goal is to never interrupt it, and that requires preparation. And if you want to always have money to never interrupt it, You can just open a YouTube channel with my help in my community in the link below, since YouTube is literally the golden opportunity of this decade. Part: How often do crashes actually happen? Before we talk about what to do, you need to understand just how normal market downturns are, because one of the biggest mistakes investors make is treating a crash like a rare once-in-a-lifetime catastrophe. It is not. There are 3 levels of market decline you need to know about. The first is a market correction. This is when the market drops at least 10% from a recent high. These are the most common. On average, they've happened roughly every 12 years since 1980. So if you've been investing for 5 years and haven't lived through a correction yet, statistically you're overdue. Corrections are normal. They're healthy. Think of them like the market hitting the reset button after prices have run up too fast. The second type is a bear market. This is when the market drops more than 20% from its peak. Since 1932, bear markets have come around on average every 4 to 5 years. They typically last about 289 days, just under 10 months. That sounds rough, but bull markets, the periods where the market is going up, have historically lasted around 965 days on average. That is more than 3 times as long as the bear markets. The third type is a full market collapse, a drop of 30% or more, often happening very quickly. These are rare, but they do happen. Think 2008. Think March 2020. Think the dot-com crash from 2000 to 2002, where the Nasdaq lost nearly 80% of its value. The point is, if you are going to invest in stocks, you will experience all 3 of these at some point. That is not a warning, that is just math. The question isn't if a crash will happen. The question is whether you'll be ready when it does. Part 3. Things you need to do with your compounding right now. Here is where it gets practical. These are the 3 specific actions you should be taking today. Not when the crash happens, because by then, it will be too late. And the third thing is the most important one, where everything relies on it. Step: protect the foundation. The first thing you need to do is make sure you have a financial cushion that you will never touch, no matter what. I'm talking about an emergency fund. And I don't mean 2 weeks of expenses. I mean 3 to 6 months of your full living cost, sitting in a high-yield savings account, earning money while it waits. Here is why this matters more than most people realize. During a market crash, people don't just lose money in their portfolio. They often need money for real life, job loss, medical costs, car repairs, all of which tend to cluster around economic downturns. And when that happens, and they don't have an emergency fund, they are forced to sell their investments at the worst possible time to cover their expenses. That is not bad luck. That is bad planning. A high-yield savings account earning 4 to 5% interest isn't too flashy. It won't make you rich on its own, but it is the thing that keeps you from being forced out of your long-term investments at the exact moment they are on sale. Think of it as insurance for your compounding. Step: set up dollar cost averaging and automate it. Dollar cost averaging is one of those strategies that sounds simple. And it is simple, but the data behind it is genuinely remarkable. Here is how instead of putting a large lump sum into the market and trying to time the entry point, you invest a fixed amount of money at regular intervals. Every week, every 2 weeks, every month, regardless of what the market is doing. When the market is up, you buy fewer shares because they cost more. When the market is down, you buy more shares because they're cheaper. Over time, this naturally reduces your average cost per share. And during a crash, it does something incredible. It automatically accelerates your buying at the exact moment when prices are at their lowest. Here is a concrete example. Say you invest $200 a month into a broad index fund. In month 1, shares cost $20 each, so you buy 10 shares. Then the market crashes, and in month 2, shares drop to $10 each. That same $200 now buys you 20 shares. Then in month 3, the market partially recovers to $15 per S-hair. You buy 13 shares. By the end of 3 months, you've invested $600 and bought 43 shares, an average cost of just under $14 each. If the market had stayed flat at $20, you'd have bought 30 shares. The crash actually helped you accumulate more. This is why crashes are not disasters for the prepared investor. They are a discount event. The keyword I used earlier is automate. Set this up so it happens without you having to make a decision every month. Because when the market is falling and your portfolio is red, and the news is calling it a catastrophe, your brain is going to tell you to stop investing. That feeling is exactly when you need to be buying more. By automating it, you remove the emotion from the equation. Step: get your portfolio properly diversified before the crash. This one seems obvious, but most people don't actually do it correctly. Diversification does not mean owning 10 different tech stocks. It means spreading your money across different asset classes, different sectors, and different geographies, so that when one area gets hit hard, the others can cushion the blow. Here is how I think about it. A good diversified portfolio for a long-term investor might look something like this. A core position in a broad U.S. stock market index fund. Some exposure to international developed markets. A small allocation to emerging markets. Some bonds for stability. And perhaps a small allocation to real estate through REITs. The exact percentages depend on your age, risk tolerance, and timeline. But the principle is you don't want all your money in one bet. Here is why this matters specifically for compounding. When one part of your portfolio crashes, you can rebalance. Rebalancing means selling a bit of what is done well and buying more of what is dropped. This is forced buy low, sell high. The opposite of what most people do instinctively. And over time, rebalancing significantly improves returns, because it keeps your compounding working across your whole portfolio, not just the parts that happen to survive. One important thing to add: diversification is much harder to maintain during good times than bad times. When one stock or one sector is absolutely crushing it, it feels wrong to move money out of it. Why would you sell Tesla when Tesla keeps going up? But that concentration is exactly what leaves people exposed when the crash comes. During the 2008 crisis, financial stocks dropped over 55%. During the dot-com crash, tech stocks lost more than 70%. People who were heavily concentrated in those sectors didn't just lose money. Many of them lost decades of compounding progress. And another thing to diversify your portfolio is just by opening a YouTube channel, with my help in my free community in the link below. Part: the psychology problem and how to solve it. I want to spend some time on this, because I think it is the part that actually determines whether most people succeed or fail as investors. It is not the strategy, it is the psychology. Here is what happens during a crash. Your portfolio drops. Maybe it drops a lot. You open your investment app, and you see numbers that are deep in the red. And your brain, which evolved over hundreds of thousands of years to respond to threats, starts telling you to get out. Stop the bleeding, sell. This is called loss aversion. And it is one of the most well-documented phenomena in behavioral economics. Research by psychologist Daniel Carnahan and Amos Tversky found that the pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. In other words, losing $1,000 feels about twice as bad as gaining $1,000 feels good. This is hardwired into us. It is not a character flaw, it is biology, but it is absolutely lethal to long-term investing. The solution isn't to somehow stop feeling the fear. The solution is to make decisions before the fear kicks in. When you're calm and rational, and then commit to following those decisions. even when everything in your gut tells you not to. This is why I keep coming back to having a written investment plan. Seriously, write it down. It should say what you are invested in and why. How much risk you're comfortable with. What you'll do if the market drops 20%. What you'll do if it drops 40%. And how long you intend to hold your investments. When the crash comes and your emotions are running high, you can pull out that document and remind yourself that you already made this decision. You already knew this might happen, and you already decided what to do. One of the most powerful stories in investing history is the story of legendary fund manager Peter Lynch. He managed the Fidelity Magellan Fund from 1977 to 1990, delivering an average annual return of 292% over that period, one of the best long-term track records in history. But he noted something fascinating. Even though the fund returned 29% a year, many investors in the fund lost money. Why? Because they bought in when performance was hot and sold when the market dropped. They let their emotions override their plan. You have to be smarter than that. Part 5. What the data tells us about staying in. Let's finish with the numbers, because I want you to leave this video with a completely clear picture of what compounding actually looks like when you do everything right versus when you make emotional decisions. We already talked about the Fidelity study, showing that missing just the 5 best trading days between 1980 and 2022 cut your returns from $1.082 million down to $671,051. That is a difference of $411,000 for missing 5 days. But here is the thing about those best days. According to research by J.P. Morgan, many of the best trading days in stock market history happened during or immediately after crashes. 7 of the 10 best single-day returns in S&P 500 history occurred during the 2008 financial crisis. If you sold during the crash to protect yourself, you didn't just lock in your losses. You almost certainly missed the rebounds that followed. This is the cruel irony of panic selling. The people who sell when things look bad are often the same people who miss the days when things turn around. And because of the asymmetry we talked about earlier, the fact that you need much larger gains to recover from losses. Missing those recovery days is devastating to your long-term returns. Now let's look at what staying invested and continuing to dollar cost average through a crash looks like in real life. Between October 2007 and March 2009, the S&P 500 fell approximately 57%. It was brutal. If you had $100,000 invested at the peak, you watched it fall to around $43,000. That is genuinely terrifying. But if you kept investing $500 a month throughout that entire period, you were buying shares at an average price of around $1,000 per unit in a broad index fund. Shares that would eventually recover to over $3,000 each by 2021. The crash didn't hurt you. It set you up. The same pattern played out in March 2020. When the COVID crash hit, the S&P 500 dropped 34% in about 5 weeks. One of the fastest declines in market history. Investors who panicked sold at the bottom. The market had fully recovered by August 2020. About 5 months later, people who stayed in, or better yet kept buying during the dip, made extraordinary returns over the next 2 years. This is not luck. This is compounding doing what it is designed to do when you let it work. So let me give you a quick summary of exactly what this all means in practice. Market crashes are not rare events. They happen regularly. Corrections every 1 to 2 years. Bear markets every 4 to 5 years. And more severe collapses every decade or so. If you invest long enough, you will live through all of them. Compounding is extraordinarily powerful. But it can be permanently damaged if you make emotional decisions at the wrong moment. The asymmetry of losses means that being out of the market at the wrong time costs far more than most people realize. The 3 things you need to do right now: build a real emergency fund so you're never forced to sell at the bottom. Set up and automate dollar cost averaging so your investing becomes a system rather than a decision. And make sure your portfolio is diversified so that no single sector can wipe out everything you've built. And perhaps most importantly, write a plan, commit to it. And don't let the fear that comes with every crash convince you to abandon a strategy that the data has proven works over and over and over again. The people who get rich through market crashes are not smarter than everyone else. They're not luckier. They're just prepared, and now so are you. If you want to see exactly how to build a simple, diversified portfolio from scratch, what to buy, how much, and where, watch this video next and subscribe. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.